Welcome to this explainer from the Mortgage Ally. Let's be real, securing a 30-year mortgage in 2026 is literally no small feat. Between fluctuating interest rates, super tight inventory, and a hyper-competitive housing market, just getting the keys can feel like you've crossed the finish line. But relying solely on that hard-won property deed to secure your financial future, well, that's like walking a tightrope without a net. Today, we're looking way past the closing table and jumping straight into the high-stakes reality of modern homeownership.
Okay, let's dive into this. It's the question literally nobody wants to ask when they're picking out paint colors or arranging the living room furniture. But honestly, it's the absolutely crucial question you have to answer. We're navigating an economy right now that's defined by this intense push-pull dynamic, where the cost of living and the cost of capital are incredibly sensitive. If an illness, an unexpected injury, or just the unthinkable happens, that massive 30-year debt obligation doesn't just hit pause. Suddenly, your family's most significant asset, your home, becomes incredibly vulnerable.
I absolutely love this quote because it hits the nail on the head. It represents a massive paradigm shift. We really have to stop viewing home buying as just a basic real estate transaction. It's not just about acquiring a property. It's about building a comprehensive financial architecture. You aren't just buying a house, You're designing a whole system to protect your wealth, and insurance is the steel framing that keeps the whole shebang standing when the ground starts shaking. Section 1. The Insurance Mortgage Nexus. This brings us right to the core concept we're unpacking today, the insurance mortgage nexus. Think of it like this. It's the strategic integration of life and disability insurance directly into your mortgage planning. It completely transforms a reactive, stressful transaction, like, scrambling to pay bills in a sudden crisis, into a highly proactive wealth management maneuver. By structuring your insurance right alongside your mortgage, you're essentially building a massive moat around your family's biggest asset. You're ensuring that an unforeseen tragedy doesn't trigger a total financial collapse or lead to foreclosure.
Moving right along to Section 2, Life Insurance Strategies, MPI versus Term Life. So how do we actually build this moat? Well, we usually start by looking at two primary life insurance models used to secure a mortgage. And the details here are absolutely fascinating because they completely dictate who holds the power if the worst actually happens. On one side, we've got mortgage protection insurance, commonly known as MPI. On the flip side, we have level term life insurance. Now, both of these are designed to protect the home so your family isn't stuck with a mortgage they can't afford, but they function in totally different ways, especially regarding who benefits directly and how much flexibility your family actually gets to keep.
Now, what's really interesting about this slide is the stark contrast in control. Take a look at mortgage protection insurance. MPI is specifically engineered to match the declining balance of your mortgage. If you pass away, the policy pays off the remaining loan. But pay close attention to the beneficiary. It's typically the lender. Yes, your family gets a house owned free and clear, which is fantastic, but they get zero liquid cash. It offers extremely low flexibility. Now compare that to term life insurance. With this, you get a fixed payout, the full face value, and the beneficiary? Those are your designated survivors. Your family actually gets the cash directly. They have incredibly high flexibility. They could choose to pay off the mortgage, for sure. Or, say the mortgage has a super low interest rate, they might choose to pay off higher interest credit card debt instead, invest the capital, or even just use it to pay for the kids' braces. Term life fundamentally protects household liquidity, whereas MPI is primarily protecting the lender's interest. Section 3. Escaping the disability trap. All right, let's pivot to a risk that is way more likely to happen, yet it's completely misunderstood in modern mortgage planning. We spend all this time obsessing over life insurance, right? But the statistical reality is that the risk of experiencing a disability during a 30-year mortgage is significantly higher than the risk of premature death. No way, right? But it's true. Think about it. If you can't work due to a severe illness or maybe a sudden back injury from your weekend warrior tennis match, how is that mortgage getting paid next month? And this right here is exactly where buyers fall into what we call the disability trap. A lot of folks falsely assume their standard employer-provided group disability policy is just going to swoop in and save the day. But here's the catch. These group policies typically cap your benefits. If you're a high-income professional, this creates a massive income gap. The absolute maximum payout from your employer's policy will very likely fail to cover a hefty 2026 mortgage payment alongside all your family's regular lifestyle expenses. You might walk around thinking you're fully covered, but the second you run the actual numbers, you realize you're wildly exposed.
Let's move to and see how this builds a rock-solid defense strategy. To actually close that scary income gap, you've got to take a few specific steps. First, you have to recognize the gap in your standard policy. Acknowledge it's there. Second, secure a supplemental individual disability insurance policy. You want one that is portable, meaning you get to keep it even if you switch jobs, and non-cancelable. Third, you'll want to add a cost of living adjustment or COLA rider so your benefits actually keep pace with inflation over time. And fourth, make sure you have residual disability benefits. This just means if you can only work reduced hours because of your injury, you're still getting partial income replacement to make sure that mortgage stays paid.
Section 4. The annual homeowner audit. Okay, so building this safety net, sorting out the life and disability insurance, that's amazing, but it's really only step one. The 2026 housing market and the broader economy are way too dynamic to just set it and forget it. You absolutely need an ongoing strategy, and that 1% threshold is basically your golden rule. In a volatile rate environment, you have to constantly monitor the market. Whenever market interest rates drop approximately 1% below your existing mortgage rate, refinancing suddenly becomes a highly viable strategy. That 1% drop, that's the sweet spot where you can meaningfully reduce your monthly payments or significantly shorten the term of your loan, which just skyrockets your equity growth. So the crucial point is that this yearly audit actively preserves your long-term wealth. Every single year, without fail, you should be doing these three things. Number 1, review your insurance limits. If you've done any renovations or if property values in your area have surged, your old coverage might not even come close to covering current home replacement costs. Number 2, monitor your property tax assessments. In some states, assessments are jumping dramatically, which will hike up your monthly escrow payments and definitely impact your budget. And number 3, always be checking for those strategic refinancing opportunities, keeping that 1% rule in the back of your mind.
Which brings us full circle back to the core philosophy of our explainer today. The successful acquisition of real estate in 2026 is defined by the quality of the financial architecture supporting the deed. Look, getting the house is great. It's a huge milestone. But keeping the house through all of life's crazy, unexpected twists and turns, that's the actual goal here. True financial preparation is the real foundation of your home, not just the concrete they poured into the ground.
I want to leave you with this to chew on. Take a hard look at your own situation right now. Is your homeownership built simply on a piece of paper, just a property deed, or is it genuinely supported by a comprehensive, risk-proof financial architecture? Have you addressed that disability income gap? Do you have the right life insurance actually protecting your family's liquidity? If the answer is no, or even, I don't know, then it's time to start auditing your own mortgage plan and build a safety net that absolutely won't fail when you need it most.